December 3rd, 2025. Daily market structure analysis grounded in Federal Reserve balance sheet data, credit markets, and real yields. This exists because most market commentary reacts to headlines. We're tracking the underlying machinery. The banks are out of emergency cash. Zero reserves left. Manufacturing is contracting while energy prices climb. That's stagflation. The economy stalls, but inflation keeps running. The Fed is trapped. They can't raise rates because it crashes a weak economy. They can't stop printing because banks need liquidity to function. So they're going to print, which means the dollar loses value. This is happening while real inflation, covered in the foundation piece, is already running 7 to 15%, well above risk-free rates. If you're holding significant cash or core index exposure without hard asset allocation, that's exposure to dollar debasement in a negative real rate environment. Gold, Bitcoin, energy, anything scarce with no counterparty risk, that's where capital is flowing structurally. Here's what breaks this thesis. Friday, December 5th jobs report. If it shows strong employment growth and the Fed still refuses to inject liquidity, this view fails. The other scenario is they allow Treasury default to defend dollar value. Current analysis doesn't point to that level of political will, but if you see evidence that contradicts this, different Fed rhetoric, policy shift signals, data I'm missing, bring it. This plays out over 12 to 18 months minimum. We're positioning for structural monetary regime shift, not trading headlines. Source data available on request. If you've got counter arguments, different data, or holes in this logic, drop them. That's how this gets sharper.